Hi everyone, let's have a look at my low time frame and micro bullish and bearish Elliott Wave scenarios on Bitcoin, starting with the triangle, which from an Elliott Wave point of view is not valid, mainly because of the volume that is not decreasing while the pattern is evolving. Because in a triangle pattern, the first wave, you want to see a solid amount of volume in the first wave, which we don't really see, and then afterwards, when the pattern is evolving, the triangle, you want to see volume decreasing to the downside. But as you can clearly see over here, volume was actually increasing to the upside while this pattern then was evolving. That's not what you want to see in a triangle, and also invalidates a triangle for me. But what I would like to see in this, let's say, triangle pattern is many beginning traders learn trend lines and learn patterns. So they will see this triangle probably all over the internet, and I would like to see a fake out, meaning we break the trend line to the bottom, for example, but then move back to the upside, or we break the trend line at the highs for then a move to the downside. That would be something I would be interested in. And then it depends, are we first going to break the one at the lows or one at the highs, right? If we then go to my first Elliott Wave scenario, we're looking at a corrective structure, which then is a 3-wave to the upside in a wave W, followed by a 3-wave structure in then a wave X. And then eventually we're going to be looking for another 3-wave structure to the upside in a wave Y, taking at least these highs over here. If we then look at the target area that I have, this target area is for the white wave Y, which is pulled with the trend-based fib extension tool from the high of W to the low of W to the high of wave X. And as you can see, the 0.618 at the moment, very nicely respected by price over here on the 1-hour chart. The 0.618 is a common target for a wave Y, so this could be a potential end for a wave Y, after which we're looking for upside. However, another common target for wave Y is between the 1 and the 1.236 trend-based fib extension, which is between 26.1k and 25.8k, which is actually quite far below the daily naked point of control. So I'm not too sure if I like price going all the way down here, because then we're going to go all the way inside this wick, and there's not much support basically below the daily naked point of control. So I don't mind price moving to the downside and hitting that daily naked point of control, as well as maybe taking this low, for example. But going all the way down here, it starts to become quite likely we might actually take the lows over here at 25.8k. But in this scenario, we are eventually looking for a move to the upside. So from a trading perspective, entering somewhere inside this area is going to be valid. Stop loss is below this low as an invalidation, and then we'd be looking for a move to the upside. Of course, no financial advice. If we then go to the second scenario, which is an alternative scenario and actually goes hand in hand with my preferred scenario. Why? Because this wave Y target hasn't been reached. Now let me explain. This scenario over here is this being a W, then a wave X. So wave X is already finished, the blue X, after which we then have a wave Y to the upside. However, this high over here clearly did not reach the 0.618 target, which is a minimum target for a wave Y in a WXY. So the fact that price with this move to the upside didn't reach the minimum target for a wave Y also makes me believe that upside is not yet finished, and we might still see a move to the upside, either go up already, move down and to the upside, but at least go back to a minimum target of this wave Y being the 0.618. Now if price is going to push further to the upside in this particular scenario with these fibs taken from the low of W to the high of W to the low of X, we also have the other common area over here between the 1 and the 1.236, which is between 28.3k and 28.7k, which also includes the highs at 28.3k over here, which is definitely a very interesting area. Just above that target area, one has to know, is also a target box which with very interesting confluence between 28.9k and 29.2k. So in this scenario, basically thinking the same, that we're not yet finished with the upside over here, and also thinking about a bit more upside still to go. Of course, if price is going to move to the downside and actually takes this low, then my very alternative scenario at the moment is that this was the end of a corrective structure, and we then have a wave 1, 2, 1, 2, and then a bigger 3 to the downside. But at the moment, also looking at the volume, clearly this is not supported, because if this is a bigger wave 3 over wave 3, you want to see volume increasing massively. And yeah, you could say, hey, we have a bit of a volume increase, but look at the volume over here, right? The volume over here was higher than the volume we are getting right now. That's not what you want to see in a very bearish 1-2-1-2 bigger 3 to the downside scenario. So also the volume at the moment supports still a little bit more upside to go. If we then go to the micro time frame, I want to explain what I've been seeing. So we had this move to the downside as we were looking for, right? We were looking for a move to the downside, either hitting this target box first before a move to the downside, or from here a move to the downside. Both are good. Then we had this target box, and it was interesting, this target area over here, because on the CVD we actually started to create some bullish divergences. So we made this low, moved to the upside, moved down, bullish divergences were created. So this could have been a potential entry for the trade, which I show here as well, because this is a trade, by the way, but the stop loss is at break even. Why? Because after this was then a potential entry, price moving up, down and up again, price started to create bearish CVD divergences. And if I show you this over here, then you will see on the blue line that price made a lower high, but on the blue line a higher high. So lower high on price, higher high on the CVD, bearish divergence. And seeing this, well, at least stop loss break even, if not stop loss in profit, or just exiting the trade just in case. And after that bearish divergence, price then moved to the downside where we are right now. In this particular scenario, an interesting target, if this is another 3-wave structure in an ABC, is then this being a wave A, 5-wave, 3-wave in the B, and then a wave C to the downside, is the target between the 1 and the 1.236. And it so happens that that target includes the daily naked point of control at 26,350. So this is again quite an interesting area, also for the area that we've been talking about, where we still expect more upside. This as a potential wave C area is quite interesting, but then again, we are bouncing on the 0.618 and we have to wait and see how that is going to develop. If we then look at the divergences on the higher time frame, the 1 hour that we have, so the bearish CVD divergences here on the chart, then these divergences are between these highs and the lower high made, where the target are these lows at 26,360. However, very interesting what is happening. We also now created bullish divergences here. So it's going to be quite a mess, right? So let's start from the beginning. We first had the bullish divergences between this low and the higher low created. The target for these bullish divergences is the high at 27.6K. Now then we started to create the bearish divergences over here. Target 26.3K. And then after these bearish divergences, now we create new bullish divergences between this low and again a higher low, where the target is 27.2K. Now from experience and from statistics, I know that the divergence that has been created first has a higher probability of playing out. And the first divergence created was this bullish divergence, right? So this one at the moment has the highest probability of playing out from a CVD statistical and experience point of view. Now, between this bullish CVD divergence and this bearish CVD divergence, the bearish came before this second bullish. So this second bullish CVD scenario is a bit more risky compared to the first one, because trading wise, trading the first CVD divergence basically means entering right there. Stop loss is going to be below the CVD divergence, and then you're looking for at least this target at 27.6, if not higher, whatever price is going to do. But of course, this second bullish CVD divergence is more risky because you also have the bearish CVD divergence that didn't yet play out, as price did not yet take the low at 26.3K. So this is very interesting. However, seeing a double bullish CVD divergence over here might also again support a bit more upside, which is still something I would be looking for. So I hope this video was valuable and helpful to you. Please check out the macro and the high time frame video if you're interested. And for now, thanks for watching and subscribing, and I will see you at the next one. Bye bye.